Welcome to Talk Tickers. This morning, we got Q3 earnings from Stanley Black Decker. And wow, it was a classic case of mixed signals. You've got a strong operational beat on the bottom line, but the market, it pointed squarely in the other direction. Let's break down what happened, and more importantly, what it means for the next quarter.
All right, here's how we're going to break this down. First, we'll hit the big numbers for the quarter. Then we'll get into management side of the story. After that, we got to talk about that market sell-off and the guidance that triggered it, and we'll wrap it all up with our take on what to look for in the next earnings call. Okay, let's get right into it, the results. And, on the surface, this looked like a pretty solid quarter. But when you look closer, it's really a split decision. The big number everyone's talking about? Adjusted earnings per share, coming in hot at $1.43. I mean, that's a huge beat against what the analysts were expecting, and it really shows they've got a tight grip on operations. Okay, let's dive into this, because this is where it gets interesting. On the one hand, they absolutely crushed it on adjusted EPS, a 24-cent beat over the consensus. That's fantastic. But then you look at the revenue line. $3.76 billion, just a hair shy of what was expected. And that, right there, is the whole story of the quarter. Amazing cost control, but the top-line growth just wasn't there.
Now let's flip over to how management is spinning all of this. Their story is all about one thing: execution. They're basically saying, hey, it's a tough world out there, but we're focusing on what we can actually control.
And on the call, they really hammered home a few key points. They talked about their solid execution, the continued strength of that powerhouse DEWALT brand. They highlighted that gross margins are expanding year over year, which is great to see. And they talked a lot about dealing with tariffs and the big savings they're getting from their supply chain overhaul.
Now, what's really interesting about this slide is this number, $1.9 billion. That's how much they've saved so far from their cost-cutting program, and they are so close to hitting that $2 billion target. This right here is the engine that powered that huge earnings beat we were just talking about. Okay, so solid operations. Costs are way down. Why on earth did the stock get hammered? Let's look at how the market reacted, because it tells a completely different story.
And this is the million-dollar question, right? If the quarter was a beat, why did the stock drop? It's the kind of thing that makes investors scratch their heads. It should be good news, but the price action was telling us the market was focused on something else entirely.
This chart just lays it out perfectly. Look at that. The stock tanked about 4.5% in pre-market trading right after the call. Sure, it clawed some of that back to close down just 1.3%, but that initial gut reaction, that tells you everything. The market was looking right past the good Q3 numbers and was worried about the road ahead.
And this wasn't just a few nervous investors either. The trading volume was almost double the average. We're talking 3.8 million shares traded. That shows you there was some real conviction behind the selling. People were clearly spooked by what the company said about the future.
And that brings us to the real culprit behind the sell-off. It's all about the updated guidance and the headwinds that management warned us about for the rest of the year. The devil, as they say, is in the details.
So here it is, the smoking gun. Management trimmed their full-year adjusted EPS guidance. They brought it down from around $4.65 to $4.55. Now, I know, it's only a 10-cent cut. But in this game, any reduction in guidance, especially right after you beat expectations for the quarter, is a massive red flag for Wall Street. So why the cut? Well, management gave a few reasons. They pointed to higher production costs, mainly tied to tariffs and their ongoing supply chain shuffle, though they think that'll get better in Q4. They also mentioned that volumes were a bit softer than they'd like, and that they took some big write-downs on non-core brands like Lennox and Irwin as they try to focus their portfolio.
Okay, so let's put it all together. What does this actually mean for the stock from here on out? Here's our take, and we're framing this as a market perform thesis as we head into the next earnings call.
Our thesis is pretty straightforward. Really, it's a three-step process. First, you've got to acknowledge the headwinds are real. The market isn't wrong to be cautious about volume and costs right now. But second, you have to look at what they can control. And man, management is delivering on those cost savings and margin improvements. So the third step is to reward that execution once all this macro noise starts to die down. And this quote really sums it all up. The market is punishing near-term volume softness, but overlooking long-term margin progress. The story is the transformation, not the tariffs. We think the market's getting too hung up on the short-term bumps and missing the bigger picture of how this company is fundamentally changing for the better.
So here's the final call. Our prediction? We think Q4 will meet that new lower guidance, but the number everyone should be watching is gross margin. That's the real health indicator. For price action, expect the stock to be stuck in a range for a while, at least until we see clear signs that volumes are stabilizing. The big long-term prize here is hitting that 35% plus gross margin target. All of this brings us to our final rating, market perform. The execution is definitely there, but those macro headwinds are just too strong to ignore, keeping it from an outperform for now.
And as always, this is not financial advice.